Morning, everyone. Welcome to Officer 24/7. My name is Niharika Walia Bhatnagar, and I am with you with the area of ABFM. Okay, I hope you have seen the Republic Day events that we are looking forward to. From 24th to 27th of Jan, all the faculties of our JIB and CIB wing is meeting you for 2 hour classes. These special 2 hour classes are prepared, and I think that's a very good idea for all of you. How is it good? The classes for 2 hours. For the next 4 days, the classes are aligned in such a way that you will have bilingual and English medium in the evening as well as in the morning time, right? So we have the maximum number of classes going on 27th, keeping in mind that is your off day as well for both the JIB as well as CIB. Rest in other ways we are conducting every single day, in the morning and the evening time. We are conducting one bilingual and one English medium class. Now, if I talk about the plus points, you just have to go through one particular subject for 2 hours straight, and then you'll be done with that particular subject for the next 4 days. So that's particular ideology. So go ahead and start this particular session. And if the entire event is something that you find useful, everyone, please go ahead and like the particular session, and don't forget to share it among your peers as well. Share it on your WhatsApp, Facebook, and whatever platform you would choose. Please go ahead and share it among themselves as well. And what are we going to deal with? As we already know, we had started with the series where we talked about the module, a specific module we had started in terms of module C. So, what are we going to do in this particular period? That is, we will be discussing a few chapters regarding module C of CIB ABFM. We are starting with the area of other non DCF valuation models, everyone. So, what is it? The various non-DCF models that we are picking up in this case, non-discounted cash flow models. Until now, we have talked about the models which are related to the area of discounted. That means we were talking about the time value of money. What if now we are moving ahead and we are talking about the organization in terms of the non-discounted? Matlab, if I'm going to receive 10 rupees in upcoming future, maybe 2 years, 3 years down the line, then I recorded it as 10 rupees only. To make the decisions, I am not going to adjust the amounts further. I'm not going to adjust the amounts. This is the purpose of other non-discounted valuation models. So let's quickly start with this particular area itself, everyone. What is the primary focus of the discounted cash flow techniques in valuing the assets? Market prices, comparable assets, cash flow, growth and risk characteristics, and economic reasoning, everyone. Go ahead and answer. Waiting for the reply. What's the first question regarding the primary focus of the technique? Everyone? What would be the answer, everyone? Okay. The correct answer to this particular question would be cash flow, growth, and risk characteristics. These are the three most important pillars of making decisions. Okay? Cash flow, growth, and risk characteristics. Okay? Acha, how does a relative valuation compare the worth of an asset with other assets in the market? By analyzing market prices, by assessing internal value meters, by comparing cash flow characteristics, or by comparing with the prices of other comparable assets, everyone. How does a relative valuation compare? Relative means, okay, relative means we are comparing two specific organizations. For example, I'm trying to value my organization, but the value of my organization can also be based upon an organization which has recently valued it and is in the same industry as mine and is working at the same level of operations as mine. So it becomes easier for me to evaluate us and do the work accordingly. है ना? So in this case, what's going to be the answer, everyone? In this case, we are comparing two different areas. We are comparing the prices of comparable assets. Comparable means, why do we use the word comparable? Comparable simply means that we are comparing two or more organizations together. You know? That is what we'll try to do. We will compare our organization with a similar organization, and it should be on, for example, if I'm an ICSE student, how can I be compared with the CBSE, though we are in the same class? The 10th class syllabus of ICSE doesn't match with that of CBSE, but I can compare a CBSE student with another CBSE student. Isn't it, everyone? This is something that we can do, and that makes sense even, isn't it? Now comes the next point. What does the relative valuation model do in assessing the value of an asset? Consider only internal value meters, analyzes cash flow characteristics only, compares the asset worth to the prices to the other comparable assets, or ignores market prices. What would be the answer, everyone? In this case, we're talking about the relative valuation model when we are comparing. Uh, it is again the same answer. It is similar actually. Compares the asset worth to the prices of other comparable assets. Comparable. Again, the parameter is based upon one particular fact that both the organizations should be comparable. What is the underlying principle in determining the worth of an asset using relative valuation? Market speculation. Next point is economic reasoning, or analyzing the internal value meters or comparing with prices to comparable assets. What would be the answer, everyone? Why? What is the underlying principle in determining the worth of an asset? Comparing with the prices of comparable assets. Whenever we are trying to do that in the relative model, it is again the same. Actually, these are a set of questions which are very similar to each other. You know? Acha, now another question comes to the relationship between discounted cash flow valuation and relative cash flow valuation. Acha, these are two different sets, hai na? If I talk about these two, when we talk about the discounted cash flow valuation and relative cash flow valuation, they say these are two different sets. DCF and relative cash flow valuation, they're interchangeable, they're contradictory, they're complementary, or relative valuation supersedes DCF. वैसे तो I don't think any of these methods can be something that is basically superseding the other one, because both methods have their own importance. Relative compares you with the one which is already working in the market, while discounted cash flow valuation helps you with the time value of money. Okay, what you are saying that you will be receiving in the upcoming future, then how are we going to receive in future? And what is that particular amount? How are we dealing with all these things? So technically, okay, I hope it's visible now. So technically, these two methods, they are not contradictory at all towards each other. Okay? At the same time, they are not interchangeable as well. They are two different methods. Relative valuation looks for comparability, while DCF doesn't look for comparability. It would review that particular case itself. So technically, in this case, the answer would be they are complementary methods. You take both these methods together and it will help you further. Done? Next question. They are complementary methods. Next question, everyone. How does the advantages result in for companies with larger multiples and in the same peer group? What do you mean by peer groups, everyone? Peer groups are basically your friend circle. You are a banker. So Everybody in the banking fraternity is basically your peer group, right? So in this case, if we talk about what are the results in companies with larger multiples in the same peer group, lower returns in on invested capital, higher risk, stronger returns as on invested capital and growth rates, or lower market value. What would be the answer, everyone? When you have a peer group, when all of you are strong enough, what will happen? You have larger multiples, you have multiple people sitting down there, and everybody has their own set of working. When you come together, you're going to be bigger than you thought. That means stronger returns on invested capital as well as the growth rates would be visible in this case. Okay? Stronger returns on invested capital and the growth rates. Which of the following is an example of stock valuation multiple? EV, EBITDA, EV, FCFF ratio, price earning ratio, or EV, enterprise value to sales ratio. These are various multiples which are used to measure the valuations of the organizations. Now, they're asking you to give the answer regarding stock valuation multiple. When we talk about the stock valuation, this is not talking about the raw material. This is actually talking about the shares of the organization, everyone. This stock is related to the area of shares. So in this case, it is basically price earning ratio. PE ratio can be specified as MPS upon EPS. Market price per share as well as divided by earning per share. Okay, that is how we define it as PE ratio, everyone. This is specifying the market price per share and divided by earning per share. This helps to find out that what is the uh, relationship between your market price. Your market price will always increase when your earning price is per share is increasing. How, everyone? If we are earning more in the future, what will happen? If we are earning more in the future, our earning per share will increase. You know? That is PE ratio. When we earn more, people will find our business or the stock to be renowned, and that is why our market price will also go up. So technically, these are also something which is positive towards each other. What are the examples of EV multiples, everyone? Or we also call it the enterprise valuation multiple. PE ratio and price book value ratio, EV divided by EBITDA ratio, EV divided by EV FCFF. FCFS is, first of all, EBITDA. This can be defined as earnings before interest and tax, then depreciation and amortization. Before paying a single penny towards all these areas, be it your lenders, be it your income tax department, be it any kind of interest, whatever income is there, that is called EBITDA, everyone. And when we talk about FCFF, this is free cash flow of firm. Done, everyone? This can also be related to the area of equity. It can also be called FCFE. What are the examples of enterprise valuation multiples, everyone? PE ratio or price sales ratio. That means you're talking about the selling price and the price. And then we have this EV to book value. Then we have the enterprise earnings and enterprise sales. They're talking about the entire amount from the sales point of view, everyone. The correct answer would be what? The correct answer is actually B, the one I just explained. This is your earning enterprise value in consideration with your EBITDA and the same with the FCFF of the organization. These are the two methods in which it is using it. What does EV to FCFF ratio focus on in enterprise valuation? Operating performance, free cash flows to equity, book value to the company, or sales performance? Everybody? They're looking at the enterprise FCFF now. In this case, actually, they are trying to find out the free cash flows that is going towards equity, because it's about the enterprise now. In enterprise, the true owner is the person who started with the business, the promoters of the organization, the shareholders of the organization. You would always want to know that what is the value of the organization in the eyes of the people who started the organization, who have the ownership right over this organization, isn't it? So it is going to be free cash flows to equity. Done, everyone? Now let's move on to the next question. In stock valuation multiples, what does the price earning ratio compare? What is it that the PE ratio is comparing, everyone? Market price per share to the earning per share, MPS to EPS. Is this PE ratio or book value to market value? Okay. Market value is the market price of that particular organization. Earning per share is basically the organization's earnings, which it is making from the market. Okay? Earning per share is the earnings that you are getting from the market. And then from this EPS, you take your MPS. Matlab, your earnings are good, then people will definitely invest in your organization. If your earnings are not good, then they might keep their hands tied, isn't it? And book value is the value which is prescribed in the account books. Okay? Fair value is not the market value, is what? At what value it is prevalent in the market right now. So technically, these are the areas. So then what would be the answer in this case, everyone? The answer, when we talk about the PE ratio, now PE ratio is again working at MPS upon EPS. Okay, what would be the market price per share and what would be the earning per share, everyone? That's the particular topic. Done. Here comes the next question, everyone. What is the common stock valuation multiple that compares the market value to the book value? Matlab, that must be MPS divided by the book value. Everyone, quickly think about the answer. What's going to be the answer in this case? Okay. When we talk about this specific area, na, just a moment, I think I missed it out. Okay, starting from this area again, in the stock valuation multiple, what is the PE ratio, everyone? When we talk about the PE ratio, in this case, would be related to the area of MPS and EPS. Okay, let's look at this, everyone. In this area, we talked about the market price per share and the earning per share. You know, we talked about MPS divided by EPS. This was your market price divided by your earnings. Then this was related to the area of market price divided by your earnings. Then we talked about the common stock. Common stock valuation multiple that compares the market value to the book value. PE ratio, price sales ratio, price to book value ratio, or EV to sales ratio. When we talk about this ratio, the common stock valuation, we are trying to find out stock here means the valuation as per the shares, where these are comparable to the market. Which in this case, we're talking about market divided by the book value. So in this case, think about it. This is the one. See, this has described as price to book value ratio. You know, this is price to book value. The price here means the market price. What are the most important drivers of valuation calculate multiples? Yeah, I think we had done a similar question in the beginning as well. What would be the answer, everyone? Is it related to industry trends and market speculation, growth, prospects, risk characteristics, and size of the subject of the company? Internal value matters and economic reasoning. And the last one is enterprise value and book value. You know? So when we talk about the most important drivers, it is related to the area of those 3 points again. Growth prospects, if the organization has a future growth, we will record it that way. You know? Then risk characteristics. What are the risks involved? Higher the risk, higher should be the reward. Lower the risk, lower should be the reward. That's the particular story, isn't it? And then we have the term size of the subject. Size means, see, if you have a bigger organization, then your growth prospects will have a definite more scope because you are already a growing and thriving organization. Otherwise, it becomes when you are trying to grow yourself, your efforts, your money, and the expansion in the market would be a little challenging, but only in the beginning. Over the period of time, this also settles down. Okay, this is related to the area of in the first edition of Security Analysis by Benjamin Graham and David L. Dodd. Which equity valuation method did they present as typical in 1934? Everyone, go ahead and answer. In terms of 1934, security analysis. Enterprise valuation multiples were given by them, discounted cash flow valuation, or PE multiple, or the book value. They can actually ask you these kind of questions in the examination. What would be the answer, everyone? In this case, the correct answer is the PE multiple. PE multiple is super important. So you find it so many places. Okay? The answer is price to earnings multiple. The PE multiple. Next question. How is this PE multiple typically defined? How do you define this particular multiple, everyone? If I have to define it, how do we define it? EPS upon MPS, or the market price per share upon the earning per share, and market value divided by the book value, or the last one, enterprise value divided by earnings before interest and tax. What would be the answer, everyone? In terms of EPS divided by MPS. This is to the area of MPS upon EPS again. Okay, the market price divided by the earning per share. Done? Chali. Now let's move on. In the PE multiple, what is typically measured as the predicted value of the current year? EPS, book value per share, market value per share, or EPS, earnings before interest and tax? EBIT. If I talk about the multiples now, always remember EBIT is the earnings that you are making before making any payment to the interest or any payment towards the taxation. So in this case, we're talking about what? EBIT, है ना? EBIT is super important, but when we talk about PE ratio, what was the formula? MPS upon EPS. So these are the two things, but one of the most important thing is which is typically measured as predicted value for the current year. We're trying to find the predicted value of current year. It is EPS. Isn't it? Now let's move on. That is EPS. What is the significance of using the PE multiple in valuation? It predicts the future market trends, it measures the book value of the equity, it provides a ratio for current market price to earnings, or it determines enterprise value based on earning before interest and tax. PE multiple. You can actually look at the formula again. That is what is very, very important. So the answer would be C, because looking at it, we always try to utilize the current market price, not the future, not the past, but the current market price. Done? Next question. According to the survey conducted by the members of Association of Investment Management and Research, what variable was identified as the most important when valuing the company's equity among the cash flow, book value, and equity, or the dividends? Dividends are part of chunk of profit that is given to the people. Which particular area in terms of this survey is identified as the most important thing in the organization? Is it EPS? Is it cash flow or book value or dividends? Everyone, what's going to be the answer? The answer in this case is going to be the book value. The most important thing is the book value of the organization, everyone. Because if you know the book value, only then you can actually find out things further. And now comes the next question, everyone. This is a question that is from the IBF book itself. Vittal Limited ROE is 25% and R is 18%. Vittal's dividend payout, they are paying a dividend of 0.5. And then G, or your growth rate of giving increasing the dividend, is 15% in the future. Then what is the fundamental point of view? From a fundamental point of view, the PB multiple is what? PB multiple is MPS upon the book value, because it is talking about the market price as well as the book value. Then hurry up and try the question. The answer to this question is 4.17, 5.17, or 4.83, or the last one is 5.63. What's the answer, everyone? Okay. Now let's move on and look at the answer. The answer, the formula for PB multiple is this, everyone. That is, you take your P upon B. This is your market price, and this is your book value. How do we find the market price, everyone? The market price can be found out by using, see, their return on equity. They have got an equity which they are receiving at 25%. The return that you will be receiving, or that this is their internal cost, is 18%. While the company pays whatever they are receiving, 0.5 of it will go to uh, the shareholders, and the remaining stays in the organization. Whatever stays in the organization will increase by 15%. Got the idea, everyone? Because obviously, whatever the earnings of the organization is, it doesn't mean the entire amount has to be levied by the organization, that the entire amount has to be given to the shareholders. Because if you give the entire amount to the shareholders, how will the organization survive? You know? To survive, it is essential that the organization keeps a little money in their savings. That is why we are using this. So they are using return on equity 1 minus B. Return on equity was given as 25%, and the 1.5 is of 0.5. 50% we pay off. Then what is the amount that stays in the organization? Remaining 50. That is going to continue in the organization, isn't it? And whatever your returns is into 0.2, 0.5 is something that you are giving out. And 50% is the one which is going to stay in. P here is the retention. Okay? And then this leads to your market price. And then how do we find the book value? Book value is basically your R, whatever the rate of return that you wanted, minus the growth. G is 15%. So in this case, the price to book value would come out to be 4.17. Everybody got the idea? An important question, because such kind of numerical questions can be asked in the examination. Especially this is a question from the book itself. The more you do these kind of questions, the better it would be, because it gives you a good level of exposure. Next question. What challenge does the analyst face when using the PE ratio if earning per share is in the red? Ratio becomes more meaningful, ratio makes no sense in terms of economic point, ratio becomes more accurate, or the ratio is unaffected, everyone. What would be the answer? Ratios might be really interesting. These ratios, there is no point that it doesn't give you the theoretical information. But at the same time, it is not a very reliable information as well, everyone. Okay? This kind of information is still not considered to be a reliable one. So, one particular point that organizations are using PE ratio and then they face a challenge while using this ratio is that this particular ratio makes no sense from an economic standpoint. This is stated in the book itself because they have different ways to write down about the solvency. ठीक है ना? In what situations might the PB multiple be more important than the PE multiple? When EPS is consistent, when EPS is extremely high or low, then when the book value per share is low, when the book value per share is consistent. What would be the answer, everyone? Where the PB multiple, the book value is better. This is where your EPS is not something stable, when it is extremely ups and downs based. If an organization is extremely ups and downs based, then how can they rely upon their profits? Will those profits lay forever? No. You know? In this case, what do we get? Your EPS is extremely high or extremely low or very variable. And you have to go to the book value because sometimes the earning per share is very much unstable. When it's unstable, then the valuation is not possible. You know? So in this case, it is always better that the EPS is done in a proper manner, and the value would be taken only if it is stable. If it keeps on changing, then we cannot rely on EPS even. Done, everyone? Again, a very important point to be noted because earning per share is the money that you are getting as a shareholder. You know, if you're getting it as a shareholder, then it is very, very important. You would like to know the original prices. You would like to know the reality of the organization. That's why the EPS is more important. Everyone, if you come first, it doesn't matter how did you reach the first position. You came first, it is first. That is what we talk about in the earning per share. It is extremely high or low, or it is something very variable. In this case, the answer is actually B na. Next point. Why might the PB multiple be deceiving? Acha, even the PB multiple can go wrong. है ना? Number one, limited disparities in the business strategy, consistency in asset requirements, considerable disparities in the amount of assets required based on business strategy, and market conditions. PB multiple, where you are recording things from the book value point of view. At that point of time, you won't get anything in terms of the book values. Book value is important because sometimes there is a considerable amount of disparities. When both the parties are having a lot of stress and tension, then it is always better that you do the fair value thing on with someone else. Considerable disparities in the amount of the assets required based on current strategy. You'll have to prepare the business strategy to take care of this part. Done, everyone? Everybody? Done? Next point. This was first one was PE, second one was PB, now next is PS. That is, what does the PS multiple or the price to sales multiple represent? Price here doesn't mean anything else other than the market price. Okay? The answer here is the market price divided by revenue per share. Why are we bringing this revenue per share? The basic reason for introducing the revenue per share here is where we are comparing these two areas. Done? Now, let's start with the next chapter as well. that is called special cases of valuation, everyone. Okay, let's continue with the special cases of valuation. Here comes the first question. What are intangible assets, everyone? How do we define the intangible assets? Non-monetary assets with tangible value. Then is financial assets devoid of physical substance. Non-monetary assets devoid the physical substance, or monetary assets having material form. Intangible, everyone. Something that you cannot touch, isn't it? What would be the answer? Intangible, tangibles are the one which can be touched, and intangibles are the one which cannot be touched, everyone. Okay? So in this case, the correct answer is going to be, what are intangible assets? We're talking about intangible assets. It is non-monetary assets devoid of physical substance. These are non-monetary in nature and they don't have any physical substance. Done? They don't have a physical base on which they are going on. For example, goodwill, patents, copyrights, trademarks. Which of the following approaches do you believe is the most for suitable for the purpose of determining the value of intangible assets? Multiple, relative, consistent, or exclusive? When we talk about the goodwills there, and when we're comparing all these things, we normally use the relative valuation sometimes, because sometimes we are trying to find out our organization's value in the eyes of the people. Sometimes they conduct surveys as well to find it out, but always remember, you cannot just choose a specific amount of your own. Matlab, in terms of intangible assets, there are multiple methods that you can use, but there is a method which is more reliable is relative. You compare Coke with Pepsi and then give the valuation. When you buy any other thing, then what do? We compare this thing or that thing or whatever they're looking forward to. Then the comparisons are always there. Chali, now done. Relative is basically comparing two different areas. Which of the following is correct, everyone? Financial companies, by their very nature and are not highly levered institutions, net interest income and fee income that are least important sources for income of a bank. The basic principle of accounting says that the capital expenses must be separated from the operating expenses. Whether this is true? If I buy a car and if I buy petrol, they are two different things. What is the ultimate beneficiary of the technological change in is always with the firm and not the customer. Everyone, which one is correct? देखिए, petrol and car, they are two different things. If I determine to work or I buy a car, my working is operating. While the assets that we are buying, we have to incur certain expenses to keep them going on. You know, in this case, the basic principle of accounting says that capital expenses must be separated, because sometimes what we can do is we can have wrong points as well. No? If I buy a car of worth rupees 8 lakh, add in the operating expense, my expenses will increase. Probably I'll end up showing losses in the organization which is right now doing fine. Is it good? No, it's not. So in this case, we're going to compare and keep your operating and capital expenses separately. The operating gets its money from the business and the capital gets its money from the reserves and all. Done? Next point. Which of the following would have a negative impact on the demand of the real estate? Low liquidity, potential of growth or capital growth, recurring income, all properties potential for redevelopment. What would be the answer, everyone? The negative impact on the demand of the real estate. Low liquidity, yeah, money is always stuck. Potential of capital growth, yes, we do. Then recurring income. This is not a recurring income. You do not sell your asset. What would be the answer? In this case, the correct answer is actually low liquidity, everyone. This is one of the basic reasons that organizations fail to. Done? Done, everyone? In this case, it is low liquidity. You need money, but you do not have money. It is such a crucial and grave situation where you do not have money to pay off. This is not good for the organization. This brings negativity. Done? Next question. What do you mean by convertible security? Okay, everyone. Ultimately, everybody wants to get equity share. So always remember whatever we're talking about. Convertible security talks about any security which can be converted further into equity. It can be bond, it can be a preference share, and this can be converted at the choice of the shareholder. It is not our choice. It is not the choice of the organization. This is the choice of the uh, equity shareholder who is holding a part in terms of the business. The bond and the preference shareholders are basically the people who are here. They will enjoy and they will leave, while the entire burden of the shareholding is on equity, everyone. So technically, what's happening? We are looking. We This is how we need to discuss the pros and cons of the investments in these areas. Done. Chaliye, then let's move on. What do intangible assets contribute significantly in terms of the market valuations? What do intangible assets contribute, everyone? The intangibles, the one which you cannot touch. Return on equity, capital ratios, PE and EV, EBITDA, and then is ratios. Intangibles cannot be done. The next question relates to the area of which of the following would have a negative impact on the demand for a real estate. What do you mean by real estate, everyone? The land and the buildings, right? Real estate relates to the area of purchasing of all these land, building, and further areas, right? So, when we talk about the impact of these, what is the negative impact on demand? Low liquidity, potential of capital growth, recurring income, or properties potential for redevelopment. So, properties potential for redevelopment is a positive point of real estate, isn't it? Then we have recurring income. Recurring income means we receive income over the period of time. Technically, this happens with the real estate. Again, a positive point. Why? Because if I have a real estate, then I will receive rental income because people are using it. है Then the next part is potential for capital growth. You have a land, you can convert it into any form for your utilization. So technically, you have a lot of prospects which with it. The only problem with this is low liquidity, everyone, because the money is blocked. Right now, if you buy a plot of land, it would in matlab, if you buy a decent plot, maybe of around 10 mallas or more, you're looking for canals and all, then it would be 2 cr to 3 cr. So when you are spending this much amount of money, you don't have liquidity left, don't you? You will have to take up loans, and to pay off that money, it becomes a challenging act as well. So then technically it is low liquidity. Then is a convertible security. Is convertible into cash at the holder's discretion. A bond or preference shares convertible at the company's option into an equity share. A bond or preference shares can be converted into an equity share at the choice of the holder. A security that can be converted into a bond at the choice of the holder. What do you mean by convertible security, everyone? Okay, convertible is something that we normally define in terms of anything which can be converted into equity further, right? I think we just did this question as well. When we talk about anything which can be converted into equity, convertible into cash at owner's discretion, nope. A bond or a preference share convertible at the option of the equity. This is the point, because bond or a debt can be converted into equity, है ना? And at the same time, or we can say the preference shareholder, they are not the true owners. They are kind of owners, but not the true owners. So they converted into equity are also covered here. Then a bond or preference share that can be converted into equity at the choice of the holder. Where technically this can also be the point by, because it is at the choice of the holder only. If you are holding the security, then you have the choice whether you want to get money from my side or you want to convert it into shares. So technically, in this case, C point is better than B point. And see, the difference is basically the choice of the holder term only. That's the additional term they have given you. Isn't it? A security that can be converted into a bond at the choice of the holder. Again, security is not the point. In this case, the answer is C only. Because that is the correct answer. A bond or a preference share where the person who's holding the bond or the preference share has two choices. Bond or the preference shareholder. They have two choices. One is to get in cash or convert it into equity. Both of them have the same option: convert it into cash or convert it into equity. Now, there are only specific types of bonds or specific type of preference shares which can be converted. Those are called convertible bonds, and in case of preference shares, they are called convertible preference shares. The ones which cannot be converted, they are called unconvertible preference shares or unconvertible bonds. The bonds which cannot be converted, they have to be paid in terms of only and only in cash. Okay, done? Okay. What do intangible assets contribute significantly to in the market valuations? Return on equity, capital ratios. Return on equity or ROE is basically the return that you are getting on depositing your money in terms of equity, everyone. Then we have the capital ratios. Capital ratios is related to the capital that you are investing in the organization. Then we have PE ratios and EBITDA. You know? Then in this case, what's going to be the answer? The answer is going to be tangible assets. We're talking about valuations. Now, intangible assets, we just cannot use the term tangible assets in this at all. So technically, this is out of the point. ROE is out of the blue point again. Capital ratios is also out. PE ratios or EV divided by EBITDA. PE ratio was MPS upon EPS, and EV divided by enterprise value divided by EBITDA. The answer should be PE and EBITDA. Next question. According to the Ocean Tomos IAMV study, what proportion of the market value was attributable to the intangible assets between 1975 to 2015? Normally, I believe data-based questions can be asked in the examination, but they won't be a huge in number. That's one particular point that would be there in the examination. Matlab, they are going to ask you questions which are based upon these kind of things, is, but ultimately there's one more scenario as well. Such kind of questions will not be asked in a huge number. Okay? There can be these questions. I don't really deny the fact. There can be questions which are related to this area. But at the same time, I strongly believe when we talk about this specific area, the chances are less that such questions would be asked a lot. There can be two or three questions and that's it. Okay? Okay. So the answer to this question is actually, you can go ahead and guess it up. The correct answer is basically 84%. The answer is D. Done? Okay. Then next question. Okay. The question tells you that how does the impact of the pressure on accountants concerning uh, the valuation of assets, intangible assets, how does this particular thing is affecting the accountants, everyone? Because obviously even the accountants are facing problems, because now, acha everyone, when we talk about these kind of assets, now these assets are subjected to what? These assets are subjected to personal bias as well. They are not revalued. Intangible assets are never revalued, they are just valued, and you can keep it only when you are merging into some other company, or other than merger you are doing something which is related to the area of say you are working towards the area of merger acquisition, you are basically merging with some organization, only then you will find it is being considered. So technically when we talk about these revaluations, it is super duper important. Okay, so in this case, accountants have successfully addressed the pressure. They haven't. They could not. Valuation analysts have disregarded the pressure. The pressure has led to re-evaluation of the model. Valuation analysts and accountants have ignored the pressure. They just cannot. So technically, what has happened is the pressure has led to the re-evaluation by the valuation analyst. Now there are so many methods that they had to build up because they just didn't had any option. If they won't make this particular thing work in this scenario, then what will happen? The organizations will face major issues, because every organization has got all these assets, you know. If they have got these assets which are intangible in nature, their valuation is the only thing they have to do. This particular portion is inescapable, and accountants have to sit down. Normally CAs are responsible for this particular work, right? They sit down and value the books of accounts as per the special event that is coming up. For example, if the organization is being bought by someone else, or anything of that sorts is happening, that is covered in this area. Okay, so in this case the answer is C. Let's look at the next question. What is one of the primary sources of information used in valuation? Market trends, economic indicators, accounting statements, or independent studies, everyone? What would be the answer according to the scenario? What would be the answer? See, one of the basic areas from where actually the working starts is, in actual, it is the area of the accounting statements. They look at the accounting statements of the organization, and based upon those accounting statements, they prepare their books of accounts. Okay? Done? So in this case, this is the financial statements is the first thing that affects the working. Overall, yes, it also gets changed over the period of time because of the market indicators as well. But the primary thing is accounting statements, because how do you prepare the goodwill of the organization? Your goodwill is based upon how old this organization is, how much money it has made over the period of time, right? If they made a good amount of money over the period of time, then they have a good goodwill. Goodwill is basically reputation. That is something which will develop, right? So that is particular thing that happens in the particular organization. So the basic answer is accounting statements. Done. Next point. What does the franchisee receive in exchange for paying the franchisor? Franchisee is something that is happening these days a lot. For example, uh, I knew someone who had taken up the um, franchisee of Subway. They took up the franchisee of Subway, and what happened was when they got the franchisee of Subway, they had to deposit a specific amount of money to Subway for the for taking down the specific uh, portion of that franchisee. And once they took the franchisee, whatever earnings they were making, they would receive it. But the Subway would people would come and check their working every now and then, whether they are following the standards and all. So franchisee owner है ना, is basically giving the money to the franchisor for what? Ownership of the corporation, exclusive right to operate the franchisee, or franchise, I would say, the power of the brand name and support of the corporation, or full control over advertising. In this case, the correct answer is the power of the brand name and support of the organization. You are using the brand name of Subway. You didn't open your own restaurant. You got the reputed name of Subway, and through the reputed name of Subway, you are selling your uh, you're making your income overall. Technically you're making your income through Subway. So then in this case, what you are doing, you're getting support from the organization. They would be guiding you there. People would come and train your chefs in order to make sure that they are learning the work and they are aligned with the working of the organization as well, right? So that's one particular important aspect, right? So what's the next point? What does the capital investment approach involve in valuing intangible assets? Comparing market values of the companies, analyzing advertising expenditures over time, discounting anticipated increase in cash flows, or isolating the effect of an intangible asset. Capital investment approach involve in valuing the intangible assets. When we talk about the valuing of the intangible assets, you have to look at the capital investment area as well. What is this exactly about, everyone? Compare market values of the companies, analyze the advertisement expenditure. What should we do exactly? See, the point is when we are trying to find out the intangible assets value in the market, that is based upon how much we are um, spending money over it. So in that case, one particular thing is analyzing the advertising expenditure over the period of time. This will help you to value the intangible asset. Okay? Analyzing advertisement expenditure over time. How does the value of building differ from that of a stock at its terminal stage? Terminal means by the end. The value of the building is always higher, the value of building is always lower, the value of the building may be less than its current value, or the value of the building may be significantly higher than its current value. What will happen? देखिए, if in terms of land, I would say the value of the land normally increases. But think about the building now. Building is different. There is no depreciation on land. Indeed, there is no depreciation on land. But there is a specific depreciation charged in case of buildings. And see, if the building gets old, then what will happen? If the building gets old, the charges are definitely there on that specific building. You know? So what would be the amount? In this case, the value of the building may be less than the current value. The value would be less, but this is not about the land. Land's value increases over the period of time. But if your building is old, definitely you'll get a lesser amount of money. That's why you will find many of the builders do this, that get uh, they get a particular place, they basically do the next part is they build it further, they create it in a better way, then they improvise and then they sell, so that the building looks absolutely no, because land value is already up. If you're in a good situation, good around surroundings, it will always be more. So then in this case you will find that in case of buildings, the value of the building will go less because it is an older construction. Otherwise you will find the land's value is always increasing. Okay, what factors determine the value of both real estate and financial assets, everyone? Types of investors and market liquidity, volume of cash flows, growth rate and risk associated, or asset lifetime and ownership duration, or estimating challenges and predicting growth. What would be the answer, everyone? Chali, let's look at the answer in this case. Volume of the cash flows, growth rate, and risk associated. Volume of the cash flows, if higher, you will look forward to that project. Growth rate, if higher, that means you have more money upcoming in your pockets in the future. And risk, which is associated with the cash flows. The risk, if higher, you would always ask for more risk premium. If lower, you will always ask for lesser risk premium. That's the goal, isn't it? Then, in terms of what does the CAPM model use to quantify non-diversifiable risk? What is the CAPM model, everyone? CAPM model is capital asset pricing model. In this, they say first of all you get risk-free rate of return. This is the without any risk. Minimum returns that you're going to get is risk-free rate of return. Then with this add up beta and you have market rate of return minus the risk free rate of return. Okay, this part is called risk premium, and if you do not take any kind of risk, this is risk free rate of return. Done. So in this case, is it risk-free rate or market beta, factor beta, or variability of returns? Diversifiable risk. The risk is basically related to the area of market beta. Market beta is the beta of the entire industry there. Okay, this is the multiplier effect. For example, the risk premium is say 20%. Your beta is that particular point which will increase or decrease. If the market changes, it has almost no impact on you. You will stay. If the market changes and you also change, it is 1. If the market changes and you change more than what the market changes, that means you are at maybe 1.2, 1.4, it can be 2, it can be 4. You have major changes if you see the market changing. Or in the opposite case, what will happen? If the market is changing, you are still stagnant, you are at 0.6 into 20%. This can also happen. Your beta can be more and less. And there were questions from this particular topic in the examination as well regarding the beta of the organization. So this time in the examination, it was there. It's an important topic to cover for the exam. That is CAPM model. Sometimes the CAPM model is also asked in the examination in the form of a numerical question as well. So take a quick look, everyone. This is the formula. This is the formula for risk. CAPM model, capital asset pricing model. Done. Chaliye. Then let's move on. Next question. What assumption do risk and return models make about the marginal investor in asset? The investor has localized expertise. The investor is not diversified. The investor participates in the real estate exclusively, or investor has diverse portfolio. What would be the answer, everyone? What assumption do risk and return models make? Matlab, I just remember one particular point of risk and return, everyone. That particular point is the the more risk you take, higher is the return. That it should be there. Na? Why would I take more risk if the returns are just meager? Then why don't I put the money towards the end of bonds? The money would move like a snail, but at least it is for sure coming to me. But in terms of equity, maybe I'll receive a huge amount of money and maybe I'll just get pennies, or maybe they will take away the pennies that I possess even. That is the point regarding the risks that we are taking. And those kind of risks are definitely dangerous for the organization, don't they? So in this case, the answer is the investor has a diverse portfolio. What do you mean by portfolio investment, everyone? Warren Buffett had once said, he said, never put all the eggs in one basket. Now, what does this particular term means? This particular term means that you should never put all your uh, money in one particular security. What if this specific security doesn't work out? You have to put the money into diverse areas so that what happens is if any one security faces a problem, the other does not faces a problem, the third one goes really well, you have a profit here, you have a profit here, and you have a loss here, you can cover it up. That is what you will want. So you can cover up the losses and you can move over towards the profits. And if the loss is minimum and the profits are maximum, then this loss is totally covered up. Yeah? That's what we talk about in the area of portfolio. That means you will diversify your risk rather than keeping it stagnant. For example, in terms of mutual funds, this is what they do. You have to decide where you want to put your money. You want to put your money in complete equity, in complete debt, or you want to put your money in both equity plus debt. So on this basis, your money would be diversified among different industries, and that you'll be receiving money accordingly. Done. Next question. Why is it challenging to assign a value to startup firms, especially those using technologies? Lack of profitability, then absence of financial statements, or when we talk about it, limited history and no goods or services to provide there and services to sell, or difficult in calculating the earnings. But in terms of startups, now they have all these problems. Personally, if I would have to tell you, startups are basically unpredictable in nature. They do not have enough money in their pockets, and their money is something which is very limited in nature. And at the same time, these organizations face a lot of unpredictability from the market side because they're absolutely new. By the time they will stand up for themselves, then there are other competitors which have already taken up their ideas and they will utilize it for their benefit. So in this case, one of the basic problems is they are just kids, limited history and no goods or services to sell. They just do not have much to serve. But if they have something unique to serve, that can be copied by the top leaders. That's why whenever you are entering the market, you have to come up with something unique, and you have to make sure that something unique that you are adding in the market, that stays there in the market, and you are getting it patented. A very basic example, WhatsApp was taken over by uh, Meta. Now Meta, it was earlier Facebook. So Facebook took over WhatsApp. It has taken over Instagram, but it didn't take over Snapchat. They couldn't. And at the same time, Snapchat has been going well because of one specific reason that people were looking forward towards Snapchat was streak. What do you mean by streaks, everyone? According to them, streaks was if you are sending a snap every single day to any of your friends, right? With every single day you have a streak. People have streaks for 400 or 500 days. Matlab every single day they are opening up their Snapchat, using it and sending that particular snap or whatever the message or whatever they are looking forward to towards their friends. And they all have different people in their link. Every single day they made sure that people are opening their app to maintain their streaks. So, and the coolest part was they patented it. Now this particular thing cannot be used by Meta in terms of Instagram. The Snapchat filters, there were many filters which it got patented, that the same things cannot be used by Instagram again or anybody else. So that is another important thing, that even though it was a startup, it was way ahead over time, and that is how it is surviving and still thriving, while rest everything else is has fallen into the hands of Mark Zuckerberg. So this is about the unpredictability of the startups there. I think WhatsApp was really very um, famous, and maybe the if the owners wouldn't have sold it, they would have made a huge amount of money. But they made a call. They sold it to the Facebook, and since then, when Facebook bought it, there are many things in terms of the working of WhatsApp, which is now totally different. It is just like any other platform there, with the WhatsApp community and everything else adding up. So yeah, it has definitely changed. Why might it become increasingly challenging for the company to sustain very high growth rate as it expands? The size of the company decreases, the company operates in smaller market, the size of the company increases, or the company becomes less competitive. Everyone, the higher you grow, what will happen? What will happen in this case? The point is, in this case, the organization faces one problem, that is, your size increases. When the company size is increasing, it is very difficult to sustain a huge number of people who are working for your organization. And then, when such a huge number of people are there, then how will you cater all these people? And they have their own calls to make as well in terms of their working. So what will happen? The size of the company increases. That's a challenging situation where over the period of time, the profit, which is way too much. See, acha nahi, there is one more point that can be there. If the increasing, if why might it become increasingly challenging for the company to sustain very high growth rate? When you are growing too much, there's only one more thing. Competitors will also enter. They will also enter. They will start taking up your market. That is also another point. Your size is increasing, you are getting bigger and bigger. Small players will also try to take over and exploit that particular situation for their benefit as well. No? Why would someone leave such an opportunity? So the size of the company increases. That is a scenario where the companies have this specific scenario. Okay, how have some investors responded to the challenge of valuing stocks with limited information, excluding them from the portfolio, then claiming the problem is with the valuation models, or developing creative explanations for the stock cost, or all of the above? What would be the answer, everyone? Everyone? Chali, then let's look at the answer. We're talking about valuing the stocks with limited information. You just have limited information. Excluding, acha, recently I saw that our stock market is now the fourth largest uh, stock market in the world. I don't know what is authenticity, whether it is actually true. I was just going through a few articles and all. So it was given there. Done. So that's one particular part, everyone. All these problems are there actually. Excluding them from the portfolio, when you see some areas or the stocks which do not have any information, you'll be scared of it. Claiming the problem with the valuation models, yeah, you'll have to do that part. Developing, creating creative explanation of the for stock costs. You will have to create. You have to develop creative explanations of these stock costs as well. This should be absolutely creative. And the last one is all of the above. The answer is actually all of the above. All these problems are there. Stock valuation is not an easy peasy thing. It takes a lot of time, a lot of homework is required. Okay? Without that long term homework that we do, an organization cannot work further. Then, why is it simpler for a business to sustain high growth rate in the markets that are expanding at high rates themselves? So now the markets are also all growing, and how do we sustain our growth rate? The one thing that I know now, when there are markets are exclusively growing up to a very good point now, people start exploiting this position. If I see one particular organization in the market is going really well, I'll try to introduce my shops as well near that particular area so that I can either uh, utilize the audience which it has brought, or I can grab the people who are standing there. For example, if you find a particular food shop which is really good, so I'll opt for maybe a shakes shop just near it, so that people can buy food from there and buy the shakes from mine. So in this case, it's either I look for the complementary area, or I'll open up similar shop so that I can beat them and I can make people eat my food as well. That's the particular thing, you know. It is more challenging to sustain growth in expanding markets. It is true. Expanding markets provide more opportunities for growth. Again, that is also true. But what are they talking about? Why is it simpler for a business to sustain high growth rates in markets that are expanding? Array, if the market is expanding, then we are also expanding at the same pace. Now, if the market won't be, then we have a problem. Higher growth rate are not influenced by market expansion. No. If the market is growing, everybody is growing. Expanding markets hinder business growth. Nope. If the market is growing, if your external area is clean, you will be bound to clean your internal areas as well. You know, because everybody is maintaining peace and the cleanliness around you. Why won't you do the same? So technically, in this case, the answer is expanding markets provide more opportunities for growth. You opened up two shops in this area. Someone else also opened. Then someone also opened. The entire market hub was created. This market hub is basically for everyone. It's not for one particular organization, but for the entire organization. ठीक है ना? Done? Got the idea? So this is the answer. So let's move on towards the next point. Why is estimating a young, high growth company operating margin when its growth stabilizes a key test in valuation? It helps in the company's revenue growth. It indicates the quality of the company's reinvestments, or negative operating margin turns positive, or it assesses the sustainability of the company's competitive advantage. But in terms of long term, now you'll always find that over the period of time, anything can turn into something else. In the long term, if you are making extraordinary money, it will settle down. If you are making extraordinary losses, you over the period of time, it will stabilize. Okay, so that's one particular point that they are absolutely clear about. So in this case, the correct answer would be that over the period of time, even when there's a problem, the negative operating margins, they also turn positive. The negativity will also turn into a positivity. So the negative operating margin also turns positive. Then what is the relationship between expected growth, reinvestment rate, return on capital as per the provided equation? Expected growth rate is equal to reinvestment plus return on capital. Expected growth, reinvestment rate into return on capital. Expected growth rate is equal to reinvestment divided by our return on capital, or return on capital minus reinvestment rate. What's the answer in this case, everyone? Everybody, what would be the answer? Expected growth. This is the growth that is something that we'll be having in our future, right? What would be the answer, everyone? Done? The expected growth rate is equal to reinvestment rate plus return on capital. No, it cannot be plus. We are investing something. Na? When we are investing, it is going to be the reinvestment rate multiplied by return on capital. If we are reinvesting it, at what rate we are getting the money? Isn't it? Done, everyone? So in this case, the correct answer is going to be the reinvestment rate multiplied by the return on capital. Done? Chaliye, now let's talk about the next question as well. The next question says this is multiplied because if I reinvest in at a certain rate and this is the return on capital. For example, you get a certain amount of return. Whatever your return is, you are putting it back into the market. This is more or less compounding now. This is similar to compound interest, isn't it? So if it is similar to compound interest, we will multiply it and we will find that specific area. So that is what we cover in this specific topic. That means we'll be covering the reinvestment of that particular amount. And if we are putting it back into the market, that means we are also thinking about expanding our source of income as well. Don't we? Indirectly or directly, this is what we're looking forward to. Right? Chali. Then let's move on and talk about the next question. The next question is, which method can be used to estimate risk parameters when a company has little historical data? Top-down approach, bottom up, historical regression, and synthetic rating approach. Everyone, what would be the answer in this case? What would be the answer? Acha, in the beginning, so definitely more or less the more questions are from a specific 2-3 chapters of the particular book, but later on I'm also covering the various topics of module A as well. Okay, so that we can have a complete revision of 2 modules at least, right? So what would be the answer, everyone? Top-down approach. Top-down is where the top level is giving instructions to the lower level. Bottoms approach, bottoms up, the method that can be used to estimate risk parameters. That even when if the organization has minimum data, na, they do not know what's happening there. That is always bottoms approach, bottoms up. You start from the closing point and then you try to reach out the beginning point, and that means you're going backward. That is how you try to find out whether the things are happening in the way you are looking forward to it or not. Okay, then let's move on towards the next question, everyone. Why do some investors choose to concentrate their portfolios in real estate, and how is this strategic decision justified according to the provided content? We just don't have to write the term provided content in this case. Just cut this part. What would be the answer according to you? Everybody? We're looking at the point of view of investors choose to concentrate on portfolios in real estate to avoid diversification. Portfolios are created to create diversification. Justified by the stable nature of real estate investments? No, they are never justified. Because if you would have seen, the real estate was also hit during the period of COVID. If you would have seen, then during COVID, these organizations faced a lot, right? Then to capitalize on specific knowledge in real estate justified by the potential for higher returns or to minimize risk. Then we have the area of justified by the securitization of real estate and to follow market trends justified by the popularity of the real estate investments. See, people have to make changes in terms of their investments, and people actually move towards the area of diversification because of certain reasons. Diversification is required when you feel that there is too much of uncertainty, but I won't say that in this area there is no speculation or there is no point that there would be a fluctuation. So why would they do it? They would do it because of only one specific reason, that is to capitalize the capitalize on specific knowledge on the real estate. We know that this particular area is good enough, and we've multiplied further. Then we can increase our returns. So we're not trying to minimize the risk because securitization is already done. Whenever we buy a real estate and we pay, we are taking loans for it, we have to give it as security. To follow market trends justified by popularity, no, no, no. Popularity and all is just not the point. Agreed, a few properties can be more favorable to you than others, but that's still not the point. The answer in this case is to capitalize on specific knowledge in real estate justified by the potential of for higher returns. Taken, it is given by specific knowledge of the high returns. If we just want high returns, obviously we would diversify our funds further, don't we? Okay, now let's move on towards the next question. What is the significance of sales to capital ratio when estimating reinvestments needs for a startup or a new company in the valuation process? It determines the risk premium, or it helps estimates to cost of equity. It measures the return on capital, or it assists in estimating growth in revenues and associated reinvestments. What is the significance of sales to capital ratio, everyone? We're taking up the sales of the organization and the capital. Okay, when we talk about the sales, this is the turnover of the business, the income of the organization, and capital is the money that you put in the organization. So if I ask you, if I put 10 lakh rupees in the business, how much is the turnover of the organization? If someone says it's like 1 crore, then I'll be like, okay, I'm putting 10% of what I'm making, and okay, in that case 10 times I'm earning. That is a good number, because if I'm uh, if I buy a car, if it is worth rupees 10 lakhs, I would always want it can cover for at least a good number of years, and I can take out all that particular benefits, reap multiple benefits out of it, don't we? That's the basic reason we buy a car. So in this case, when estimating reinvestment needs of startups, reinvestment needs means, first of all, you earn, and then the same amount you're not withdrawing from the business. It is still in the business in the same way, everyone. So if it is in the same business in the same manner, then technically, what is it that we are doing? It helps estimate the cost of equity. It determines the risk premium. It measures the return on capital, or it assists the estimating growth in revenues and associated reinvestments. In case of new companies or startups, what are they doing? It is helping them. It assists in estimating growth in a revenue and associated reinvestments. We are working towards the area of reinvestments, everyone. We are putting this money back into the business, and this is always better, even because when you make good money, why to put more of your personal funds? Money basically becomes the magnet, and it will attract more money. So it is always better that whatever you're earning from the business, that same money is put further into the expansion rather than your own personal money. Because the personal money, when put into the business, that means the businessman is not wise enough if he is using too much of his own capital and not the money that he is making from this business itself. And how does the securitization of real estate contribute to the argument against the assumption of non-diversifiable risk? Securitization minimizes risk. Real estate investments become risk free. Investors can hold both financial assets and real estate investments simultaneously, or the risk premium for a real estate decreases. What would be the answer, everyone? What would be the answer to this question? When we talk about this specific question, that is securitization, we are looking forward towards is putting the real estate in terms of the security, and this contributes towards the an argument against the assumption of non-diversifiable risk. Sometimes you cannot diversify risk, it is not possible. So it is investor can hold both financial assets and real investments, real estate simultaneously. They can do both the things. There's no problem. Rather, they put up the real estate into the security form as well. So then it will not hamper your other assets. You just keep this real estate in terms of a liability, and if something bad happens, then this real estate is the sole asset which is under threat, not others. So in this case, the answer should be the investors can hold the financial statements, assets, and the real estate investments simultaneously. Next question. Why do some analysts argue that traditional risk and return models may not be suitable for estimating the cost of equity in real estate investments? The real estate investments lack risk. Real estate investors are overly diversified. The models assume non-diversifiable risk which may not hold in the real estate, or real estate investments have a fixed risk premium, everyone. Acha, I hope the question is visible right now, everyone. What would be the answer according to you? What would be the answer, everyone? The answer to this question is the models assume non-diversifiable risk which may not hold in the real estate. Normally, when we talk about the traditional risk, they were not looking for diversifiable things. They were always looking towards non-diversifiable. This is the new thing that was introduced with the models that have been recently taught to us. That is one particular thing, everyone. Okay. Then, so let's move on towards the next topic. Acha, what is work specialization, also known as? This is a question from the area of module A, everyone. Work specialization. How do we define the work specialization, everyone? Once you do a specific thing for a long period of time, what will happen? If I'm doing a specific thing time and again, then then it would lead to a work specialization. Why do I say work specialization, everyone? I keep on doing that particular task every now and then. Now, this work specialization is also known as task differentiation. Task differentiation is basically two people having different set of tasks. It is different. Division of labor. Division of labor can be taken because what you're doing is your work is divided. I'm in the HR department, you are in the finance department. We are doing our task every single day, repeated basis, and then this will be dividing our labor. You know, if the labor is divided into different sections, they do that particular work every now and then what will happen? After a certain period of time, they become experts in it. Hierarchical structuring is based upon the hierarchy of the organization, senior to junior. So that is not the point in this case. That senior to junior thing is definitely not there. Team collaboration, that's not the point at all. Team collaboration is related to the area of collaborating with other people to work, while work specialization is doing the particular task time and again. So that is division of labor. This is one of the first, Henry Fayol had given 14 principles. This was among his 14 principles, everyone. Division of labor, division of work overall. That is how he defined it. Division of work. When you divide the work among different people, that is how we will get to know the work. Okay, what is the authority in context of organizing? Acha, another pointer, uh, in terms of organizing, how and where does the term authority stands? And what exactly is authority, everyone? It is a person's charisma. Uh, a person who's charismatic can be a spiritual guru. You know, he can be fluent and a very influential politician. He can be a very good orator. He can be any of those sorts. He can be someone who can publicly attract a lot of people. That's person's charisma. Then is a power to issue orders and make decisions on behalf of the organization. And informal, that can be the point. Second can be because authority means power. But what does it mean? Power to command over others, right? Informal influence within the organization, no. Informal and formal, there are two different words. But in this case, informal influence is not the point. Employees' popularity, again, that's not the point that we're looking forward to. Authority is basically the power to command over others. Uh, if we are listening to someone who's senior to us, now the senior point is not related to the age criteria. There are people who are sitting at the higher positions at a very young age. They are sitting at that position because they have the particular ideology, they have the particular leadership skills. That's why they're sitting at the top now. And at the same time, if they're sitting at that particular position, then they have the power. Maybe they'll be lean. Maybe there's a woman and maybe there's a very old person. Maybe you'll find someone who's very weak in terms of the body, but they're still influential enough that they can take care of the company. That's because organizational hierarchy gave them the power. We didn't, but the organization hierarchy definitely did. The power to issue orders and to make decisions on behalf of the organization. That's the point. Next question. In the chain of command, who typically has the most formal authority? Entry level employees, managers, top level executives, or specialized workers? In terms of chain of command is basically uh, this is basically in terms of chain of command, we define senior to junior. Okay, that's called the chain of command. It is also called as scalar chain. Then we have entry level employees, uh, who typically has the most formal authority. In terms of the formal authority, it is the top level executives, everyone. Reason, the entry level employees or the lowest level employees, they are the first line managers. They are the first level of managers which are there in the organization. Then they have their seniors as middle level, and then comes the top level. Top level is the authority which distributes its power over the different number of people who are working under it. So technically, the number of people who are working in these organizations is increasing further, isn't it? So in this case, what do we get? In this case, we get the particular top of answer of top level executives. Okay, so today we have covered a major part of module C, 2 3 chapters which are quite typical. We have covered the point of view of those chapters along with a little part of module A, everyone. So if this particular class was helpful for you, please go ahead and like it, and at the same time share it among your peers in on the Facebook, WhatsApp, wherever you are actively involved in the social media. Please share it among your peers. And at the same time, if you haven't subscribed to our channel yet, subscribe to our YouTube channel, Office Adda 24/7. Along with this, if you haven't downloaded our app, you should download the app because at this point of time, the sales are going on, about which just I'm about to tell you. So let's open up and learn about that. Okay. Uh, this is our website, that is www.adda247.com. Go on to the area of JIB and CIB. Go on to the area of CIB June 2024. You can see the CIB Mahapack is having double validity. Double validity means you have previous classes, current classes, and the future classes. All these things are available, and uh, ebooks are available, test series is available, 500 hours of live classes are available, all the 4 subjects plus the fifth optional subject, all the 5 topics of optional subjects are available. You can watch any of those without any restriction, and you can choose which particular optional subject that you want. Along with this, the bilingual and English medium, both batches are opened up for you. So whatever is there, everything is opened up. In terms of this, if you have taken this up, you don't have to pay even a single more penny. Okay, that is the power of the Mahapack. For Mahapack, you just have to pay if you utilize that particular code, that is Y, code that you have to use is Y541 and apply it. You will get it for 6823, everyone. This is 79%. You will get another 1% discount if you are using through app. That is why I asked you to join the app, because once you have got the app, you will be able to get more discount. See, 12 months and 6,823 rupees. Technically 500 something rupees per month. Not a very significant amount, isn't it? And you get entire information regarding CIB. You don't have to pay even a single penny for CIB preparation after you have bought this. You will get so much of data. That is really good amount of data, I can say, because all the previous batches, current batches, and upcoming batches, everything is open. That means for the next 12 months, whatever we are putting in from pin to an elephant regarding the CIB batches, everything would be available to you. You know, there is no restriction how many times you're opening it up, how many times you're dealing with it. All those things are there. So this is the power of our Mahapack. And if I just preparing कि नहीं, I just want the 4 subjects only. I don't want to prepare the 5th one. I don't want to go for the optional one. Then go on to the main platform www.adda247.com. Go on to the area of CIB June 2024, and you will find our Shapat batches, Nishchay batch, as well as the batch that we are introducing in terms of our English medium, that is scholars batch. Okay, in terms of scholars batch, you will be able to find it. Along with this, the resolution batch has also begun. This is the current batch which has just begun. It started from 10th of January. So this is resolution batch. This includes all the 4 subjects: ABM, BFM, ABFM, as well as BRBL. In these, all these specific subjects are covered. Test series is covered. Ebooks are covered. What is not covered is the revision batch, or I can say along with the revision batch, it does not cover the other subjects as well. The 5th optional subject. See, if you buy it for that particular one, 6823, and here you have to pay. If you apply the code Y541, you get a discount of 79%. You're paying 5039. Everyone, 1800 rupees more, and then you get everything. Revision batch, optional subject, all the 5. You can watch any of these and you can choose. Bilingual, English medium. Huge amount of data opened up for you. For the same time, it is for 12 months. And look at this, the validity here is for 6 months. Isn't this costlier? And that particular Mahapack cheaper in terms of the per month scenario, because it's for 6 months and that is for 12 months. So go ahead, look at these particular offers, and this offer is ending soon. So I would request you all, if you want to enroll, do not wait for a longer period, because it will again hamper your economic process in terms of going for this particular courses, because it would be costlier after this particular offer is over. So go ahead and check it out on our website, on our app, for further details. The best thing is download the app and check out all these particular batches, so that you can make your mind that this is what I want from the particular course, and this is what I would like to buy, right? So please go ahead and check it out on our website or on our app for further details, and keep learning, everyone, and keep growing. That is the most important scenario for every person who is preparing for CIIP. So all the very best, keep on learning and enroll yourself as early as possible, because